Well, thank you, Bruce, and good afternoon, everybody. And first and foremost, congratulations to all 97 Chartered Banker MBA graduates we're recognising this afternoon. And I hope we will get to meet many of you face to face, together with some previous graduates who have not had the chance to meet face to face very soon too. Congratulations on becoming chartered bankers with the world's oldest institute of bankers, the Chartered Banker Institute, and on gaining your MBAs from and becoming alumni of, as Bruce mentioned, one of the UK's leading universities, one of the world's leading banking universities too, which continues to go from strength to strength in its global leadership in both research and teaching, as not least the Chartered Banker MBA programme itself demonstrates. So I hope you know all about the university's proud reputation for banking, having studied with Bruce, Stephen, John and colleagues at Bangor over the past couple of years. But did you know, and this takes me on to the subject I've been asked to talk about this afternoon, that Bangor was just a few months ago ranked the 15th most sustainable university in the world, and at the same time also ranked first class in the People and Planet University rankings for its commitment to sustainability within its own operations, and also for promoting sustainability in its teaching, research and business activities. And just as being green and sustainable is a competitive advantage for universities, so is being green and sustainable often expressed in terms of making a commitment to achieve net zero emissions by 2050 at the latest, a competitive advantage for businesses in so many sectors. I would probably suggest almost all sectors these days, and that's true for banking and financial services as well. And it's something that I firmly believe is already shaping and will continue to shape the future of financial services worldwide. And that means it will shape your future careers as the leaders of banks and financial services firms for many years to come. In fact, alongside digital and data-driven finance, which you'll have studied during the MBA, sustainable finance, by which I mean how we align banking and finance with the objectives of the Paris Agreement on climate change and with wider aspects of sustainability, such as those set out in the UN Principles for Responsible Banking, Principles for Responsible Investment, and the 17 UN Sustainable Development Goals. This will shape all of our futures and the futures of the institutions we work for and we lead. Now, aligning banking and finance with the objectives of Paris was one of the key themes at COP26, the UN Climate Summit, which is hosted in Scotland, where I am today, just about 3 months ago. And I was lucky enough to be there on behalf of the Chartered Banker Institute. And like many, I think I would summarise COP26 overall that it achieved more than was expected, but less than is needed. So that is, good progress was achieved in encouraging countries, especially many of the major emitters of greenhouse gases, to be more ambitious in terms of their climate action plans. But in many respects, key details were lacking, and the pace of government climate action is in most cases insufficient to keep global warming to less than 2 degrees above pre-industrial levels by mid-century. But it's not just up to governments and intergovernmental organisations to tackle the global issue of climate change. Banking and finance have a really key role to play too. And I say this partly because it's our sector and our profession, my sector and my profession, but mainly because it's actually set out in the Paris Agreement itself. Now, the Paris Agreement on climate change has 3 objectives, and the first is fairly widely known. I hope you're all aware of it. It's to limit global warming to below 2 degrees and ideally to as close to 1.5 degrees above pre-industrial levels as possible. The second Paris Agreement objective is also fairly widely known, to promote climate resilient development, to make individuals, communities and countries better able to withstand the impacts of climate change. And given the global reach of the Chartered Banker MBA, I know that that's of real importance and timely for many of our students, our alumni, our members who work in countries that will feel the direct impacts of climate change much more intensively and more rapidly than we will do in the UK. But the third of 3 Paris Agreement objectives is not so well known, and yet it's critical to achieving the first 2 objectives. Article 2.1c requires countries to make flows of finance consistent with lower greenhouse gas emissions and climate resilient development. And I think it's very telling that the Global Climate Change Agreement singles out the critical role of finance, our critical role. And as the world overall and countries one by one do adopt more ambitious, in many cases statutory and binding net zero targets, then finance, so banking, investment, insurance, accounting, every aspect of finance will be expected and in many cases required to play a leading role in the transition of energy, transport, agriculture, buildings, production, consumption, in fact, every economic activity, every economic entity to sustainable low or zero carbon models. This isn't just about identifying and investing as early as you can in the next Tesla. The key role and the real opportunity for banking, particularly lending banks and bankers, is in financing the transition of existing high carbon firms and sectors to sustainable low carbon business models and technologies. It's financing through the transition that's key. And it's some of these opportunities that I'd like to focus on today, because as current and future leaders in banking, you should be identifying and pursuing these to deliver sustainable returns to your investors and shareholders, and also delivering positive social returns to your communities and your other stakeholders too. So here's the good news on climate change. We know what we need to do to tackle the climate challenge in terms of the mitigation, the adaptation that's required. We have the technologies we need to transition to net zero by 2050, although many need to be substantially scaled up, such as carbon capture and storage. And we know how much it will cost to achieve the transition. Different estimates are given, but the estimate I find plausible is around about $6 trillion a year, according to the G20, for the next 15 to 20 years. So perhaps some $90 to $100 trillion overall. Now, these are eye-watering sums, the equivalent of the annual expenditure on the Apollo program, plus post-World War II European reconstruction combined. But we do have the capital required, largely held in savings balances around the world, especially in Southeast Asia. So at one level, this is all very simple. All we have to do is make sure banking and financial services does what we're supposed to do best, transforming savings balances into the investments we need, in this case in sustainable technologies and infrastructure, and that transition of existing high carbon business models to sustainable low carbon alternatives. Whatever the precise costs of that transition, the scale of investment means that public funds won't be sufficient. In fact, it's estimated some 80% of the funds need to come from private finance, hence the excitement and interest in this area from leading financial institutions and investors worldwide. Now, as I mentioned earlier, almost every economic entity needs to transition, but the pathway for each sector, and in many cases for each organisation within each sector, will be different. There isn't always a simple template that can be used. What's needed are banks and bankers with a deep knowledge of the businesses they lend to, banks and bankers who are trusted advisors to their customers, to their business communities, highly trained, highly skilled bankers, just like all of our chartered banker MBA graduates. Your customers, your communities will need your advice, your expertise, your finance, increasingly so, to help them move to more sustainable low carbon business models and invest in cleaner technology, production and distribution. So this is partly about developing a knowledge of green and sustainable finance, of climate change, of transition pathways, of science-based targets, but it's actually more a knowledge of banking, of finance and of lending that's really needed to support this, much more than a deep knowledge of climate change and sustainability itself. Because the great majority of the products and services that support the climate transition are the products and services that experienced bankers are already familiar with, just with an added sustainability wrap. Increasing demand from companies and institutional and retail investors for sustainable investment and lending products and services create opportunities for the banks and bankers that can capture these. So just to give some examples, at the large corporate end of the market, a green bond, or one of the many emerging types of sustainability, SDG, sustainability linked bonds, are simply bonds from a financial perspective, albeit ones that seek a sustainability return alongside a financial return. At the moment, the United States, via Fannie Mae, the mortgage agency, has been the biggest single issue of green bonds for some years now. I think this year it'll be overtaken for the first time by the EU, which has plans for up to 250 billion euros of issue. But in fact, the corporate green and sustainable bond market is growing and growing fast in many parts of the world. And quite interesting, there's now evidence in Europe of an emerging greenium that's making corporate treasurers sit and take notice. In other words, green bonds are now pricing more competitively than their vanilla equivalents, as demand is higher from institutions and investors keen to decarbonise or at least tilt their portfolios more towards green. And in the mid-tier, green loans are simply loans that seek an environmentally positive impact and require disclosure and verification of this. I mean, of course, there are some extra costs and complexities involved in issuing green loans around disclosure and verification and the documentation and the contracts required and so on. But as the market grows, the costs continue to come down to a point where, at least here in the UK, green loans are themselves now priced at or often below the price of a vanilla equivalent. Sometimes reflecting some subsidy, but very often perhaps reflecting a lower credit risk, and again, the desire of institutions to green their lending portfolios. And one area we're seeing develop in the UK and in Europe in particular at the moment is what are referred to as sustainability-linked loans, by which I mean lending that isn't just green or to something that is seen as green or clean, but lending that seeks to incentivize improving sustainability performance. So that transition, it could be environmental performance, it could be social performance, it could be a mixture, through margin enhancements, through lower covenants, or through other incentives if agreed sustainability targets are met during the tenor of the loan. In other words, these are great products for supporting that transition to more sustainable business models rather than simply lending to a company that has a new technology that is green. And last year saw very substantial growth in the sustainability linked loan market known as SLLs, including what's currently the world's largest SLL, a $10 billion revolving credit facility for a AB InBev led by ING Bank in the Netherlands. And in fact, European banks such as ING and BNP Paribas are amongst the innovators and leaders in these areas and well worth looking at. On the retail banking side, there are many opportunities too. We're seeing the rapid development now of green mortgages. In the UK, we now have some 31 green mortgage products in the market, according to the Green Finance Institute, up from just a handful this time last year. And again, as with commercial lending, a green mortgage isn't hugely different to a standard mortgage. The main difference is usually a slightly reduced interest rate, where the discount relates to a property's energy efficiency. The theory here being that the more energy efficient a home, the lower the utility bills, the higher the proportion of income available to service the loan, and hence default risk is reduced. Of course, when mortgage rates are very low, as they are in the UK and many parts of the world at the moment, discounts are not huge, but could become more significant if, or perhaps when, rates rise more substantially than they have recently. And with inflation at 7% in the US, nearly 6% now in the UK, probably not that far away. Also, in terms of housing and reducing emissions from housing, we're seeing the development of financing to support the retrofitting of property to make it more energy efficient, which is a particular problem for countries like the UK, where if you've had the chance to visit Bangor and you've seen the area around the university, some of the Victorian terraces and so on, you'll see we have many beautiful houses and buildings, but they're very old. They've got very drafty doors, windows and walls, coupled with antiquated heating systems, meaning that some 20% of the UK's greenhouse gas emissions come from the property sector. Technically, it's perfectly possible to retrofit most buildings. The problem is it's expensive. So replacing gas heating with heat pumps or hydrogen, even for a small family house, the cost in the UK is around £20,000 on average. Significant savings in energy costs should accrue, however, especially now with higher energy costs already going up and on the horizon. So it's a great idea for financial innovation, or great area of financial innovation, if the savings can support repayments of a loan for capital expenditure and generate returns for both lenders and borrowers over that period. It's not quite as simple as that, and it's fair to say that no one has really cracked this market yet, although a great deal of thought and effort is going into it. So perhaps this could be an area where there's an opportunity for bright and entrepreneurial MBA graduates with a good knowledge of banking, if you happen to know anybody who might fit that criteria. And this kind of general model, financing higher capital expenditure to be repaid through lower operating expenditure, can support the further development of the electric car market, other clean and green technologies with substantial upfront costs followed by low running costs. And in fact, this basic model, financing CapEx through OpEx savings, lies behind much of green and sustainable finance, whether that's at the retail level or at the wholesale level, the construction and operation of wind farms or solar farms. So these are just some examples of the kinds of opportunities out there for banks and bankers in supporting customers and communities' transitions to a more sustainable, low carbon world. But alongside the commercial opportunities, there is for me a compelling moral case too. Supporting the transition to net zero and a more sustainable world in general are opportunities for our banking and finance profession to demonstrate the positive social purpose we have, and it will help us continue to reconnect banks and society. So by doing what we do best, connecting savings with investment, in this case investment in lower greenhouse gas emissions and climate resilient development, banks and bankers really can help to save the world. We can, and I would contend we must, to set out in the Paris Agreement, play a leading role helping individuals, communities, countries and the world as a whole transition to a more sustainable, low carbon model, creating at the same time shared and genuinely sustainable prosperity for current and future generations. And if we can successfully combine the environmental and the moral imperatives with the commercial opportunities, then I think we create a very dynamic and hopefully unstoppable force within finance to tackle climate change. But banking and the world needs new leaders able to rapidly seize the opportunities that this presents. And that's where I'm convinced some of the very best opportunities lie for you, our Chartered Banker MBA graduates. You have the opportunity to make a very substantial difference and to make the world a much better place for your colleagues, for your customers, for your families and your friends. So good luck, and remember as you do that, that your institute, the Chartered Banker Institute, together with our colleagues at Bangor University, will be here to support you as you go out to shape a stronger banking profession and, I very much hope, a more sustainable world too. Thank you very much.